Welcome to today's Explainer. We're jumping straight in because today we're unpacking an absolute heavyweight in the global financial world, BNP Paribas. As we move through the second half of 2026, anyone tracking the markets knows this is Europe's largest bank by assets, and they've just dropped some seriously impressive numbers that we absolutely need to talk about.
Just a super quick piece of housekeeping before we get going. Our goal here is purely educational. We're looking at a completely objective, data-driven analysis based entirely on publicly available info as of August 2026. This isn't financial advice, so you should always do your own research. Okay, let's dive into this. Here's our blueprint for today. We'll start with Europe's banking giant, then a Q2 financial masterclass. Next, market and analyst reactions, followed by future growth and looming risks. And finally, we'll wrap up with the final verdict. Let's get right to it.
Okay, part one, Europe's banking giant. To really understand BNP Paribas, you have to wrap your head around its sheer scale. We are talking about nearly 2.8 trillion euros in total assets. To put that into perspective, that is roughly equivalent to the entire GDP of France itself. They command a massive market capitalization of about 123 billion euros, with a truly global footprint spanning retail, corporate, and investment banking. It's a behemoth.
Now you might be wondering, how much of their profit actually comes from their home country? Well, prepare to be surprised, because it's less than 10%. That's right. Despite being the absolute crown jewel of French banking, less than a tenth of BNP Paribas' profit before tax comes from France. So why does this matter to us? Because it means they are highly insulated from localized economic shocks. It is a masterclass in geographic diversification. They've essentially spread their operations across Europe and internationally, maintaining that strong European heritage while operating with a completely dispersed global risk profile.
Moving right along to Part 2, a Q2 financial masterclass.
On July 23rd, the bank reported what can only be described as a blowout. We're talking about their strongest revenue growth in about a decade. Group revenues surged 12% year over year to 14.1 billion euros. But the bottom line, even more impressive. Net profit jumped a whopping 33.4% to 4.345 billion euros, comfortably crushing analyst estimates across the board. Now, to be fully transparent here, that profit surge was definitely helped out by an 858 million euro one-off capital gain from a strategic insurance asset sale. But even so, operating income still climbed a very healthy 15.9%. And for the shareholders out there, they bumped up their interim dividend to 3.23 euros per share. That's a nearly 25% increase.
But beyond the revenue and the profit, there's one specific metric that regulators and analysts watch closer than literally anything else: the Common Equity Tier 1, or CET1 ratio. This is essentially the ultimate measure of a bank's capital strength. It's their financial cushion against the crisis. Well, in Q2, they hit 13%. So the crucial point here is that they didn't just hit their target, they locked in this fortress balance sheet a full 18 months ahead of their end of 2027 schedule. That is a massive flex.
So how exactly did they get there? BNP operates on a rule of three business model. This means they rely on three highly integrated divisions that support and balance each other out. And right now, every single engine is pulling its weight. Corporate and institutional banking surged 12.7% to 5.3 billion euros, largely thanks to a record-high 43% spike in equity and prime services. Commercial and personal banking brought in a steady 6.9 billion, up nearly 5%. And investment and protection services, that jumped a massive 27%.
Right, on to part three, market and analyst reactions. So how exactly is Wall Street pricing in this decade-high growth? We looked at the ratings from 21 covering analysts as of August 2026, and the consensus is pretty striking. We've got 14 buys, 7 holds, and exactly 0 sell ratings. Honestly, getting 21 Wall Street analysts to agree on anything is kind of like herding cats. So seeing a 0 sell profile in the hypercritical world of European banking analysis, well, it brilliantly illustrates the incredible institutional confidence in BNP's current trajectory.
The stock itself is currently trading around the 112 euro mark. The average 12-month target sits at 116.38, but some major players see way more upside. Goldman Sachs and Intesa Sanpaolo both set high targets of 136 euros. Now contrast those high expectations with the bank's actual valuation. It's trading at a price-to-earnings ratio of just 9.7x. For a bank generating double-digit revenue growth, a multiple under 10 implies the market is heavily discounting the stock. In fact, firms like Bank of America have explicitly called it too cheap given these underlying earnings.
Let's move to part 4, future growth and looming risks. Because as focused learners, we can't just drink the Kool-Aid and look at the bull case. We need to pivot and objectively weigh what could accelerate this momentum versus the structural and legal risks that could completely derail it.
Let's start with a massive future catalyst, the AXA Investment Managers integration. This was a 5.1 billion euro acquisition that completely reshapes their asset management footprint, creating a 1.5 trillion euro European powerhouse. The integration is moving fast. They already merged legal entities across Asia back in July, and management just hiked their annual cost savings target from 700 million to a full 1 billion euros. Add to this their rapid expansion in the US, specifically their Miami office, which just saw a 47% revenue growth, and you have some highly potent strategic drivers for the future.
But it's not all sunshine and rainbows. There is a serious shadow looming over this growth, and it's what analysts call the Sudan legal overhang. Let's map this out objectively. In 2025, a U.S. jury found the bank liable for atrocities committed under Sudan's former regime. BNP filed its appeal in May 2026, arguing that Swiss law was misapplied by the trial court. The critical detail here is the waiting game. A decision from the U.S. Court of Appeals isn't expected until 2027. Regardless of which side of the aisle you fall on, this legal uncertainty acts as a major psychological barrier for institutional investors.
Then there's another lingering question, and it's all about leadership continuity. Jean-Laurent Bonnafé has been the CEO since 2011. That's a 15-year legacy. Recently, the European Central Bank directly queried BNP Paribas, basically asking for a clear explanation of their succession plans. Now, the bank did just raise the age limit for the CEO role from 65 to 68, which suggests Bonnafé isn't packing his bags tomorrow. But introducing management transition uncertainty into a highly complex global bank, that is always a risk factor analysts have to price in.
Which brings us to part 5, the final verdict. Let's bring all these moving parts together into a rapid-fire synthesis so we know exactly what to take away from this explainer. When you pit the bull and bear cases against each other, the tension is crystal clear. On the bull side, you have the strongest revenue growth in a decade, a fortress 13% capital ratio achieved 18 months early, an incredibly cheap PE ratio under 10, and a handsome dividend yield. On the bear side, you've got the geopolitical and legal reality of that 2027 Sudan court decision, the short-term operating expense pressure from integrating AXA, and the looming uncertainty of eventually replacing a 15-year legacy CEO. But despite those dark clouds on the horizon, the vibe inside the bank is undeniably confident. CFO Lars Machenil recently noted that they are, quote, really firing on all cylinders, which is honestly a perfect summary of their diversified internal mechanics working at peak efficiency to support the broader economy.
So what does this all mean? It leaves us with a final, provocative thought to consider. We are looking at an institution that is dominating its sector, crushing its capital targets way ahead of schedule and returning serious capital to shareholders. And yet, it still trades at a multiple that suggests deep, deep skepticism. With a PE under 10 and record-setting growth, is the market still structurally underpricing Europe's biggest banking giant? That is the core tension for anyone tracking BNP Paribas this year. Thank you so much for joining me for this explainer. Keep learning, stay focused, and I'll catch you next time.